Investing in the stock market is not a piece of cake. As of October 2022, there are over 7,000 companies listed in the Bombay and the National Stock Exchange combined. अब ढेर सारे स्टॉक्स में से मुट्ठी भर स्टॉक्स छांटना पापड़ बेलने से कम नहीं, especially for someone who is just taking their first steps in the stock market. So at this point, you could either choose a relatively easier path by dumping your investments in a mutual fund and share a piece of your profits with the mutual fund in the form of management fees and charges, or you could watch this video till the end and learn how to invest in the stock market by yourself, so you don't have to compromise your profits with any firm or entity for the sake of managing your funds, which is not that big a deal, and you could pull it off by yourself really easily. To make things easier for you, ताकि आपको stock picking पहाड़ चढ़ने जैसा ना लगे, we are going to talk about how to pick the best of the best stocks, what does price to earning, earnings per share, free cash flow, etc. mean inside a balance sheet, and also throughout the video, we'll have a look at a few top stocks listed in the Indian stock market, their price, and see what story do their balance sheets have to tell. So make sure you stick till the very end, as there's some really exciting stuff coming up ahead. Step number 1. Choose between large, mid, or small cap companies. The market cap of a company refers to the size of the business. It is measured by multiplying the current price of a stock of a company with the number of stocks issued by the same company. The market capitalization of a company helps to sort out big companies off the stock market from startups and relatively small public listed companies. Reliance Industries, for example, has a current market price of 2,400 rupees with around 6 billion issued stocks, making its market cap an astonishing 16.7 trillion rupees. This was an example of a large cap company. Companies like these have a slow and steady growth trajectory. They're also called blue chip stocks and are relatively chosen for non-volatile and slow growth portfolios. However, if your plan is to yield year-on-year 30, 40 or even 50% returns, then opting for mid and small cap publicly listed companies like Castrol India and Whirlpool Limited should be the way to go, since there's relatively more room for growth in medium and small businesses than inside a large cap company. This ultimately leads to yielding higher and better returns for your portfolio. However, there's a cost to that as well. Most of the small and mid-cap companies are relatively volatile and are expected to fluctuate 5 to 10% on a regular basis. So the goal should be holding tight and planning a long-term investment of around 5 to 7 years to witness the best performance of these companies. On the other hand, if you're looking for stable returns and don't mind compromising on relatively low returns, only then large cap companies like Reliance Industries, Hindustan Unilever and Nestle India should be the focus of your radar. Next on the list is step number 2. Listen to what the financial reports have to say. Every publicly listed company releases financial reports regularly 4 times in a financial year, with a gap of 3 to 4 months. Each time the reports are released, the business discloses information such as how much profit they generated, what were the operational costs, its current assets and liabilities, etc. These metrics help investors to determine how well the company is performing amongst its competitors and helping to predict the odds of the company performing consistently in the future as well. In the same way that an academic report card identifies a student's weaknesses, a financial report provides similar information and saves investors from losing their money before investing in unprofitable companies. Here are a few technical terms that may seem difficult for new investors to understand. Let's have a look at them individually. First, the relation between gross income, net income, and profit margins. Measuring a company's profitability on the basis of total income is one of the most common mistakes among newbie investors. The total income is generally referred to as the goods or services that the business sold for a given time period. What differentiates quality stocks from not-so-quality stocks is the persistence the company shows in maintaining or even consistently growing its total income and profit margins. Here are a few companies having consistent net income reports. Britannia Industries, one of India's leading food-producing companies, has annual gross sales at over 9,000 crore rupees and a net income of around 1,500 crore rupees after deducting tax and production costs. Deepak Nitrites, a Gujarat-based chemical-producing company with products used widely in the paint, cosmetics, and other industries. Their gross income stands at roughly 6.6 thousand crore and net profit at 1,000 crore. There are plenty of even more quality stocks out there, but the point is to teach you guys to pick quality stocks. So at any day of the year, you could one day be successful at the art of making money from the stock market. The reason behind analyzing the income statement of a business is to check whether the business is doing a good job of keeping its operational costs under control or not. Though there's no definite answer to how greater or lesser should the net income be, since it highly varies from industry to industry. However, a negative net income is a red flag, and a repeatedly negative net income shows that the business is struggling to have enough profit margins. Number 2. Cash flow. According to Peter Drucker, an American writer and businessman known for his writing contributions to the world of finance and business, entrepreneurs believe profits are what matter the most. But by the end of the day, cash flow is what really matters. So what is cash flow? In simple terms, cash flow is nothing more than the cash that flows throughout the company, or the cash a company keeps in its reserves. If a company brings in net sales of, let's say, around 100 rupees, then after subtracting all the production costs, debt payments, etc., the company is left with around 20 rupees net income. Now ideally, if the business has future plans of growth, then it would dump this 20 rupees of profit back into the business, so the business could have some cash in hand when there's a need of it. This cash in hand is called cash flow, and it generally indicates how strong a business is financially backed or how well it will deal with unexpected situations. Most of the industrial manufacturing related businesses are hungry for cash flows. It is common for public companies in these sectors to have scarce cash flows, so no need to worry if that is the case. Though a serious red flag in a business is consistently depleting cash flow amounts or consistently negative cash flows, which would mean that the company is running its operations with borrowed money, or in other words, the business is struggling to cover the costs to keep it running. Number 3. Let's see what story the EPS or earnings per share of a company and a few other stock picking ratios have to tell. Earnings per share or EPS is a common metric used to carry out corporate value. It can be defined as the value of earnings per outstanding share of common stock of the company. EPS indicates the company's profitability by showing how much money a business makes for each share of its stock. The EPS figure is determined by dividing the company's net profit by its outstanding shares of common stock. In short, the higher the EPS number, the more profitable the company is. Now that we have seen and learned how to check how well a company is performing, let's have a look at what the PE ratio offers and see how you could have a sneak peek at the sentiments of the market regarding a particular stock. Perhaps the most popular financial statistic in the stock market discussion is the PE ratio. The ratio is used to find out the value of the company, whether it is overvalued or undervalued. What you'd really have to do is take the price of a stock of a company divided by the EPS you've just calculated like I told you above, and you'll get your PE ratio of the company. Once again, why PE ratio? What's so special about it? Here's the answer. Investors and analysts use the PE ratio of a particular company to track its own growth. A high PE ratio compared to other stocks in the same sector indicates that the company is overvalued or the investors are expecting high growth rates for that particular stock in the future. A low PE ratio indicates a red flag. So let's say even after watching this video, you still managed to miss a few quality checks while picking stocks, then this step could save your neck and let you know there's something not right about the stock and you need to double check before making the choice of buying it. But why be so picky? Why be so uncompromising while picking stocks? The point is to get hands over the best of the best stocks out there, not to run behind the brands of the market. For example, Reliance, Airtel or Berger Paints, which are often referred to as the blue chips in the Indian stock market. And 9 out of 10 times, stocks like these are on the bucket list of almost every new investor who steps into the market. This way, the stock gets overcrowded and in some way upscales the price of the stock. According to Ben Graham, investors should purchase stocks like you buy groceries, not like you buy perfumes. Step number 3, sort out companies with easy-to-understand business models. According to Mr. Warren Buffett himself, only buy something you'd be perfectly happy to hold even if the market shuts down for 10 years. So what's the point in having to look at the business model if the company is already generating enough profits? Guess what? Reading out numbers and analyzing a balance sheet of a business isn't enough. You need to understand how a business operates, see how the company brings in cash flow, and what are the future prospects of the business. This will help you decide whether the company is here to stay and compete or will get wiped out by the market. Let's say there are two companies, Company A and Company B. Both of them generate profits from selling shoes, but by using a different business model. Company A sells a pair of shoes for 1,500 rupees, but spends around 1,450 rupees sourcing the raw material plus operational costs. Then it is found that the net income stands at merely 50 rupees per sale. If we divide net income by total income and multiply that with 100, we get what's called profit margin, which stands at 3.3% for Company A. On the other hand, if Company B uses a different strategy to sell the same shoes, they'll source ready-made shoes from China at a much cheaper price, let's say 1,200 rupees, and then sells them at the same price Company A sells them for, which is 1,500 rupees. Then, if we do the maths right, Company B turns out to be more profitable than Company A since they're saving their production costs as well as cash flow, as they're directly importing ready-made products, saving cash flow from getting stuck into heavy machinery, raw materials, etc. Hence growing the profit margin to up to 20%. Hence, in this case, the second company's business model turns out to be more profitable even if the first company manages to sell more shoes. If you're just starting out, then looking for companies in the construction and development sector or stocks that fall in the consumer-driven category should be your ultimate choice. Companies like Tata Chemical, Ramco Cement, and Ashok Leyland, etc. fall into this category. So some basic research skills and access to the right learning resources are the key to a successful experience in the stock market. In the end, we'll wrap this video with a famous quote from the king investor, Mr. Warren Buffett himself. The best investment you can make is investing in yourself. The more you learn, the more you'll earn. I hope this video turns out to be useful and cleared all the doubts and hurdles an investor would normally face while picking quality stocks. If you want us to make similar tutorials and guides over more exciting topics in the world of investing, then let us know in the comment section. Till then, this is Omega Finance signing out.